So tonight we're going to learn how to build your own profitable strategy at the same time. Use my three-step strategy as your basis because you should always try to make each strategy your own. Following blindly some strategy or what somebody tells you is a big mistake. You should understand and use or adapt each strategy to the way you trade. Now, there are probably as many trading strategies as there are traders. I suggest that you find some strategies and then build a trading plan around them. There's a plethora of trading strategies available to you, but I also encourage you to create your own trading strategies. When you build and test your own strategies, you are the master and you understand all the ins and outs, and you are not just trying to duplicate someone else's thoughts. And that's the problem. Even in tonight, I'll explain to you my strategy, but you're not going to be able to get into my head and suck out all those thoughts. Believe me, when you go online, you read about somebody else's strategy, whether it's a 1,000-word article or whether they put an ebook together with 50 pages on it, you're still not going to be able to suck every innuendo out of somebody else's mind. So I always encourage traders to develop their own trading strategies, time permitting. There are several reasons why I believe it's important for traders to develop their own strategies. First of all, creating strategies requires the trader develop a greater knowledge of the market and its price movements. Secondly, when one develops their own trading strategy, they are tuned into how the strategy works, what will cause it not to work, and then they will be in a much better place to adjust it when needed. Even if you trade someone else's trading strategy, test it thoroughly, and in the process, you will make it your own, and you will learn all the ins and outs of it, and possibly adding your own twist. Now, I understand this is the time-consuming part, but it can also be fun. For me, the real fun is testing out what I produce. But before we can test, we need an idea. So how do I generate ideas, or how do I generate an idea to start building a strategy around? I look at past charts and current charts. I look for opportunities that I missed after they're over. I say, oh, wow, look at that. The euro grabbed 18 points today or 28 points today, and I never even saw the opportunity. What could I put together so I don't miss it the next time? So I look for where there was money to be made that I didn't see it when it happened. In short, you want to analyze your charts looking for opportunities. Examine those opportunities and instruct how you turn those opportunities into real money without exposing yourself to excessive risk. Once you've gone through several opportunities in this fashion, you'll be well on your way to creating profitable trading strategies. So you want to see if the strategy worked on recent movements. Looking at more 20 or more trading signals. Check the profitability by adding up the wins and losses. Make sure that it works. Use test and timing. And you want to filter your inputs. But ultimately, you want to test and modify, but you don't need to reinvent the wheel. You can learn from trading analysts and experienced traders. They are still in the market because they are successful. Study their strategies and learn from them. But don't follow them blindly, but test out what they are saying and make it work for you. Now, technical analysis shows the likely market direction based upon internal trading market factors, such as the number of buyers and sellers in the market. However, the overall direction of the trading market is heavily influenced by the real world. So you want to study economic events such as growth figures and interest rates. Our trading experts carry out extensive fundamental market analysis and produce daily reports and recommendations. Now, keep in mind, not every strategy or not one strategy will give you everything. So decide what you want to accomplish it. Do you want this strategy to give you just trading signals, just to alert you when there's a potential opportunity? Or do you also want to do you want it to give you entry points and exit points? Now, the trader will use trend lines, oscillators, visual identification to determine the type of market that the price action is presenting. Strategies in a flat, ranging, or trending market are bound to contrast strongly with each other. So there's lots of different strategies. You can have a multitude of different strategies you apply at different times to the markets. And when you see a particular thing happening on your charts, you say, this is the strategy I'm going to use. I'm going to use my reverse setup strategy, or I'm going to use my double header momentum strategy. You have a multitude of strategies. They've all been tested with time, and you take the one that fits what you see in your charts. So my triple strategy is to use support and resistance, trend lines, and volume. I'm what I call a price action trader. I look at price. Okay. I'm a firm believer in support and resistance. Always trade with the trends, and I think volume is the best confirmation tool. Now, we understand when you're trading CFDs, you can't get actual volume because what you're getting is the broker's volume, or you're getting the volume from the liquidity provider. But they are still a good filter system for what the market is doing. So upon deciding on the technical analysis tools, the analyst must decide on the periods, ranges, or which values must be supplied. If you're using software, you can use a lot of software to do most of this. I do everything by hand. Today's traders have many advantages over the past, but diligence and patience may not be one of those. So once the technical tools are set up, we must now seek the signals that will show us the trade opportunities created by investor sentiment and temporary imbalances in the market. So let's start now by placing support and resistance on our charts. Regardless of what time frame you use, whether it's 1 minute or weekly, you will see where prices moved up and hit a resistance level, reversed from our price, and has moved down and hit a support level. Those are very basic ideas of support and resistance. Look for a series of low points where price does not fall below any future support level. Okay, so let's go over to a live chart and take a look. Now, there's many ways you can get support and resistance. Now, you can have short-term support resistance or long-term. Now, the only support and resistance levels, now these are the horizontal lines, the red lines you see on my chart. These levels are only important around today's price. Now, once you've been trading for a long time, all of your support and resistance levels will be on your chart. So as price moves up and down, those other ones become more relevant to the current market. See, here we have gold ones. Now, my color coding is a particularly personal color coding. There is no set way that you set up support and resistance legends and color keys. I do it to tell me how important that level is, how long ago was it a recent level, is a long-term level, is it a major level, has it been supported many times in the past? Because all of these are important factors to me in my trading. And once you've set them up, you don't have to go back and do anything again, because as price moves back in that range, you'll just continue forward. So what we would look for is a significant price. We can see when price was moving up here, it came to this high and then bounced off and went down to that low. Does that tell us anything? No. But if we were to look to move to the farther, we would say, look how important that price level was here. Look at all the opens and closes we have at that level. We then have another candlestick. So that tells us that this level, that price, is important. But because it's only a short term, we didn't go back and look too far back. I would make this, say, green. That tells me if it's a short-term level. So I haven't gone back yet on my charts to see when last time the euro dollar was trading at this level, how important was that price? Where's my teaching chart? Okay, so right now, the only thing we're concerned with I'm just trying to get the only thing we're concerned with is the support and resistance levels above and below this current price. So that's a pretty wide gap. So we would want to go back and look farther back on price and find other levels that are important. But look at that. We also can see right here that look at all this. This becomes this level at 118, say 160, was strategically important when price was there. But then look at this here. We get all of these closes right at that level, and it was important. Now here it just broke through there, but here when it was moving up, look, it came all the way up to that level, bounced off, came all the way back down, even the next time it's so that gives us that level. So what we're doing is defining more and more levels around price to help us get some understanding, because this is only my own strategy. And this is only a starting point. We're not making any decisions. We're not making any predeterminations. We're looking for a potential trade, but the trade hasn't fit our definitions yet. Now, this trend line here is no longer valid. Now, ultimately, we also want to look for the trend. Remember, I told you, we always trade with the trend and preferably a valid trend line. Now, this is the only trend line that we could draw over this period for price, because no price could have broken that trend line, and we would need 3 points of contact, 2 to draw it, 3 points to validate it. So here we have 1, here we have 2, 3, 4. So we actually have a valid trend line. So now what we're looking at is price as it's moving forward should intersect with this trend line or stay above that trend line. It should stay or some point bounce off of this resistance line, this resistance line, and this support line. So right now we see prices bounce off of this support level is moving up to its next resistance level. I'm not saying it can't break through. It's not saying it will break through. It's just telling us these are points of interest in the path of this asset. Now, the third thing we want to have on our charts here that's very important is our confirmation indicator, which would be volume. Because we should see volume increase as we get a trading potential that is valid. So in other words, if price bounces off the trend line, stays above and goes through this resistance level, we should see an increase in volume. So let's go back to my PowerPoint for a second. So once a support level is identified, draw a horizontal support level and wait for price to fall back to that support level. When price falls back and touches that support level, wait for that candlestick to close or play and place a buy stop order 2 to 5 pips above the high of the candlestick that touches the support level, and place a buy limit order so that when price reaches it, it activates it. Okay, so in other words, since we've isolated our support and resistance zone, we've isolated our trend line, what we could do is play the bounce. We would set So now it has moved up here. What we would want to do is set a potential buy order, sell order, for when price bounced off of this level. But we would need it after it touched this level. And we would put our stop loss a couple pips above our limit order here and our execution order at that level. And we could then play this three-part strategy and make the profit as it bounces off this resistance level and moves back to the support level. But we always want to see it bounce off of not just support level, but off the trend line. Because if the trend line gets closer and closer to that support level, we have less play because it's intersecting that decision-making capability. And keep in mind, we always want to be calculating our risk reward ratio to make sure that we can make a trade that has enough profit built into it. And the important thing is that you can buy immediately at market price when the price touches that level for a buy limit or a market, or place your stop 10 to 30 pips below the support level. That depends on what time frame you will be using. Larger time frames may require larger stop losses. Well, I don't trade in any larger places, and I'm looking to close my trade in a relatively short period of time. So it's easy to see. It's price. Now we were looking at a live chart, actually, so it's doing exactly what we have in here in the graph. So what we would see is bounce off of resistance, bounce back here. So we would buy when it bounced off of the support level again, with our buy order high enough off that if it doesn't turn around, reverse. Okay, our stop loss order, and then we would have our stop sell. This will be our take profit. Then again, when it bounced off the resistance level, okay, we would do the same thing, and we could trade it up and down, up and down. So many traders consider price action to have a special relevance when identifying support and resistance for one compelling reason. The market has actually traded this asset at those levels in the past. So the more the merrier, the more times it's hit that resistance or support level, the better it is. Now, which element of support and resistance works best? Well, it depends on your strategy. None of the support and resistance levels have any predictive behavior. Each is simply a probability that we won't be able to determine until the trade is over. But these levels can help traders build their approach to work with those probabilities, looking to limit risk with maximizing gains. So the meat of the strategy is still very much going to be based around risk management because of a single unifying fact that you will never know what the next candle on the chart will be. So these trend lines indicate up or down trends, either a minor or a major trend. For a market whose trend is up, we use green trend lines. For a uptrend is defined by higher tops and higher bottoms. See here, trend line up, red trend line down, trend line up, and the uptrends are always drawn over top of trend lines are always, uptrends are always drawn underneath the price, and downtrends should be always drawn over top of the price. Now, exit and entry points. You have choices. A buy can be taken near an old bottom, or a sell can be taken near an old top. A buy or sell can be taken when a stock or an asset crosses former tops and crosses a series of bottoms or previous bars. Or you can buy and sell at a secondary reaction after the asset has crossed previous tops or bottoms. We have to add one more indicator which will serve to give us more market detail in a different manner. So we could add Bollinger Bands, as they will help us see market volatility, market swings, and give us some entry points and alerts. Okay, so let's go back to our chart again. I'm sorry. And let's add one indicator on here. So in this case, we're going to add Bollinger Bands to help us see the volatility of the markets. And so Bollinger Bands is the narrow blue line here. If you don't know how to use Bollinger Bands, we have a whole 1 hour class. But the width of the Bollinger Bands tells us how volatile the markets are. And the upper level, the upper line and the lower line, the blue lines, are 2 standard deviations from the moving average. And price should be doing what we call riding the bands. See, when price rides the bands, we have a beautiful downtrend. That's a tradable trend. When it bounces in, doesn't mean it's over. When it stays below the moving average, it can continue down. But riding the bands tells us the trend is very strong. Then you get the rejection and tells us that trend may be in trouble. And then when it breaks the moving average, tells us that trend is technically over. So that helps us make a decision with our support and resistance levels, because here we had the breakthrough of what was a resistance level before. And look at that. Look how price came right down, rode down the Bollinger Band, okay, and then got rejected when the Bollinger Band moved sideways in the band, as well as bounced off of the trend line and stayed above that support level. Now we might want to change our charts into a shorter time frame. This is a 1 hour time frame because we're trading in short term. So we might convert it down to a 30-minute chart and now we get more detail, which will also help us determine a better entry level or exit level and see the more trade clearly. Or we might even want to go tighter. But the smaller we go, the more hectic the market looks. Okay, the more because you get more and more lines on your trade. I tend to trade from 30-minute to 1 hour charts. Okay. So I would wait because price is in the middle here, so we can't get anything here. So I would wait for price to come up here and then take a sell when it didn't break through the resistance level, and I would trade it down to this level, and I would put, I can ride the market as far as I am, but I'm going to use that level because I have my trend line intersecting because I have to have my target level to set my risk reward ratio, and I would put my stop loss just up here a little bit and take my ride down there. But again, I'm only offering you pieces of a strategy that you can put together to build your own 3-step plan. Because you always want to back check it. You want to use demo accounts. You want to use historical charts to see if you had applied this, where would it have worked? So after you determine a set of rules that would have allowed you to enter the market to make profit, look for those same examples and see what your risk would have been. Determine what your stop will need to be in the future trades in order to capture profit without being stopped out. Now, keep in mind that many strategies don't last forever. They fall in and out of profitability, and that is why one should take full advantage of the ones that still work. If something has worked for the past few months or over the course of the last several decades, it will probably work tomorrow. But if we never looked at the past to test this strategy, we might not even realize if it was there. Because what happens is you'll put together a strategy, and right now we have a risk on market, okay, that's being affected by a global pandemic and economic recovery. Well, then your traders are in a certain frame of mind. When you go to a risk off market, that frame of mind changes. Now, that doesn't change the assets, but it means sometimes those strategies that we're working on a risk on market won't work with a risk off market. So you have to be checking because the markets are completely different at times. And when you don't adjust your strategy or take some strategies, say these are out of fashion right now, find out what's in fashion, you'll find out that you're trading a strategy that's petered out and all your profits gone down the tubes. So strategies fall in and out of favor over different time frames. Occasionally, changes will be needed to be made to accommodate the current market or a personal situation. Create your own strategy or use someone else's and test it on a time frame that suits your preference. By using what the past has shown us, we can make ourselves some great starting points to making more money and avoid losses as we become more experienced traders. Track all strategies you use so that you can use the strategies that work again when conditions favor it. So thank you very much for joining us. I hope I gave you a little bit to think about. And if you have any questions, go to Invest Markets. They'll be glad to hook you up with a financial analyst who will show you how to do this, help you transition it into your own strategy, and help you get set up trading in the markets. So thank you once again, and have a great trading day. Bye now.